In this video, we will talk about married couples filing jointly and how that impacts their Medicare tax contributions. And so with the first one, we will talk about a married couple making less than $250,000 a year. If a couple makes more than $250,000 a year, the calculation changes a little bit. So that's why we have to do the calculation. Their tax class is married filing jointly as compared to single, as compared to married filing separately. They are hourly wage earners and they are paid weekly. Bob makes $19.20 per hour and worked 44 hours that week. Pat makes $22.50 per hour and worked 48 hours that week. For this problem, we're only going to calculate Bob's weekly Medicare tax. Assume overtime hours remain constant for the year. First thing we're going to do is calculate gross pay for each person. We have to do that to see if they collectively make under $250,000 per year. So Bob's weekly pay, regular pay of $19.20 an hour times 40 hours comes up with that number. Bob's overtime pay is $19.20 times the 1.5 premium pay times the 4 hours, which is the number of hours over 40. To come up with this number, gross pay is simply adding these two numbers together. For Pat's weekly pay, regular pay, $22.50 per hour times 40 hours for the regular pay comes up with this. The overtime pay is $22.50 an hour times the 1.5 pay premium times 8 hours of overtime, hours over 40. To come up with this, Pat's gross pay is simply adding these two together. So now we have to determine the collective pay for the married couple over the course of a year to make sure it's less than $250,000. So Bob's annual pay is weekly pay, which is that, times 52 weeks. Bob makes $45,926.40. Pat's annual pay is $60,840. Together they make $106,766.40. That is definitely less than the 250, so our calculation is not as hard as it would be if they made over that. Since they're married, filing jointly, and making less than $250,000 a year, we're going to use strictly the 1.45% Medicare tax. And again, we're only calculating Bob's. We could do Bob's and Pat's, but I'm only asking for Bob's in this example. So the annual Medicare tax is the annual pay, which is going to be Bob's annual pay of $45,926.40 times the 1.45% or 0.0145 in decimal form. Bob's annual Medicare tax is $665.93. To determine Bob's weekly Medicare tax, you simply take the annual tax of this divided by 52 weeks in a year, and Bob will pay $12.81 in Medicare tax each week. In this scenario, you have a married couple again making less than $250,000 a year. Their tax class is married filing jointly, MFJ, not married filing separately. They are considered to be salaried exempt employees and paid bi-weekly. Mooney makes $82,420 per year and worked 50 hours that week. Manny makes $149,500 per year and worked 48 hours that week. For this problem, we're going to calculate Mooney's bi-weekly Medicare tax. We could have done Manny's or we could have done both, but I just chose to do Mooney's for this example. Since salaried exempt, they are exempt from receiving overtime. Person does not receive overtime pay. Since they are exempt, they're not going to make more than this amount. Since no overtime pay to push them over $250,000, if you add $149,500 plus $82,420, you're going to be less than this number. We're going to use the 1.45% tax only. So we're going to calculate the biweekly pay for Mooney. Since Mooney is paid bi-weekly, we're going to divide by 26 pay periods. So bi-weekly gross pay, 82,420 divided by 26 results in $3,170 in gross pay. To calculate Mooney's Medicare tax for the bi-weekly period, we simply take the 3,170 times the 1.45% and come up with $45.97 in Medicare tax for that pay period. In scenario 3, we have a married couple making less than $250,000 a year. Their tax class is married filing jointly, MFJ, not married filing separately, which is different. They are salaried non-exempt employees and they're paid weekly. Sam makes $96,720 per year and worked 47 hours that week. Jazz makes $93,080 per year and worked 48 hours that week. For this problem, we're going to calculate Jazz's weekly Medicare tax. Since salaried non-exempt, they are eligible for overtime pay. So we have to do the calculation of how much they're making with consideration for overtime pay. We're going to assume overtime hours remain constant for the year. So first step, since overtime eligible, convert salary to equivalent hourly wage. So Sam's equivalent wage is $96,720. We're going to divide by the number of hours, work hours in a year, 2,080, to come up with an equivalent wage of $46.50 per hour. Jazz's equivalent wage is $93,080, which is there, divided by 2,080 hours in a year to arrive at $44.75 per hour. They're not really getting paid by the hour, so to speak, but we have to convert it so that we can figure out how much overtime we need to pay them. So now we're going to calculate weekly pay for each person. So Sam's regular pay is $46.50 times 40 hours in a week. So that arrives at $1,860. Sam's overtime pay is $46.50 times the 1.5 premium times 7 hours of overtime pay, which comes out to be this number. Sam's weekly pay with overtime is $2,348.25. Similarly, for Jazz's weekly pay with overtime, you simply add those two together to come up with this number. The next thing to do is calculate the gross annual pay to determine the tax rate. We are doing this to make sure that they don't exceed the $250,000 a year, which would change our calculations. So Sam's gross pay is the weekly pay for Sam, which is this times 52 weeks, which comes out to be $122,109. Jazz's gross pay is the weekly pay of this times 52 weeks. To come up with this, the cumulative gross pay for the couple with overtime is $243,113. Now notice that if you added this number and this number together, it would be a lot less than this because we have to factor in the overtime. Since they are married, filing jointly, and making less than $250,000 with overtime included, we're going to use just the 1.45% Medicare tax. So for Jazz, we take the weekly pay of $23.27 times 1.45% to come up with $33.74 in Medicare tax per pay period. For Medicare tax calculations, married filing jointly, now we're going to have a little bit different scenario than we've had in the last three. We have a married couple making more, not less than $250,000, but more than $250,000 per year. The tax class is still married filing jointly, not married filing separately. They are considered salaried exempt and they are paid monthly. Always pay close attention to this and this because you could have the right answer but just not apply it to the right pay period. Aubrey makes $140,000 per year and works 44 hours a week. Alex makes $120,000 per year and works 54 hours a week. For this problem, we're only going to calculate Alex's monthly Medicare tax. Since salaried exempt, neither person receives overtime pay. So all we have to do to decide if they exceed the 250 is add these two numbers together, which puts us at 260,000, which is above that cap. We're going to calculate how much total Medicare tax for the year. Since married, filing jointly, and making more than 250,000, actually making 260,000, we're going to use the 2.35% Medicare tax for any amount over 250,000. In this case, it'll be 10,000. So total income was 260,000, just adding these two because they do not get overtime pay. The lower rate is going to be 250,000 times the 1.45%. So we say, all right, we're going to charge you at 1.45% for the first 250,000. So that comes up with that for the year. The higher rate is for the remaining 10,000, and we're going to take 10,000 times 2.35% to come up with $235. The total Medicare tax, the lower plus the higher rate, is these two numbers, which comes out to be $3,860. That is how much Medicare tax the couple has to pay together, not per person, together. Now we're going to determine the ratio that Alex should pay. So Alex's ratio is Alex's income divided by the total income of the married couple. Alex makes $120,000 per year out of the $260 gross that they both do. So the ratio is 46.15%. So now we're going to determine the total annual Medicare tax that Alex should pay. So Alex's amount for the year is $3,860, the amount that they're going to both pay, not individually but together, times the ratio that is really Alex's part of it. So the 3860 times the 46.15. So Alex should pay $1,781.39 for the year. Now, Alex is paid monthly, so now we have to determine how much of that is paid each month. Pretty straightforward. The Medicare tax for the pay period, since paid monthly, divide by 12 months. So Alex's monthly Medicare tax is $1,781.39 divided by 12 pay periods, or $148.45 per pay period. In this last scenario, we still have a married couple making more than $250,000 a year. Their tax class is still married filing jointly, not married filing separately or single. They are now salaried non-exempt, and they are paid bi-weekly. Emerson makes $109,824 a year and works 44 hours a week. Presley makes $118,976 a year and works 46 hours a week. For this problem, we're going to calculate Presley's bi-weekly Medicare tax. If you added these two together, you would say, yes, of course, that's less than $250,000 a year, so we don't have to worry about using the 2.35% tax rate. However, they are salaried non-exempt, so they are eligible for overtime pay, so we have to figure out how much their annual income is with overtime included. So we cannot trust this number when it's non-exempt. We're going to assume overtime hours remain constant for the year. Since overtime eligible, we have to convert their salaries to an equivalent hourly wage. So Emerson's wage is $109,824 divided by the number of work hours in a year, which is 2,080. This number comes from there. Presley makes $118,976 and divided by 2,080. That comes from there. And the equivalent hourly wage for Emerson is $52.80. For Presley, it's $57.20. Second thing is we're going to calculate the weekly pay for Emerson. So we look at just the regular pay, the non-overtime pay, $52.80, which is there, times 40 hours, and you arrive at this number. The overtime pay is still $52.80, the equivalent pay, times the 1.5 premium, times the 4 hours above 40 that's eligible for overtime premium pay. You arrive at this number. The gross weekly pay for Emerson is simply these two numbers together. We do the same thing for the weekly pay for Presley. Regular pay, $57.20 times 40 to come up with this. The overtime pay is $57.20 times 1.5 times 6 hours above 40 to come up with this. Gross weekly pay, add the two together. The next thing we must do is to see how much they actually made a year with overtime factored in. So Emerson's income is the weekly pay times 52. Same thing for Presley. So Emerson's weekly pay is going to be this, and we're going to multiply it times 52 to come up with $126,297.60. Presley's income is going to be this times 52 weeks to come up with $145,745.60. So the total household gross income is above $250,000 a year. So we have to do that 2.35% rate for any amount above $250,000. Since they are making more than $250,000 as a couple, we're going to use 2.35% Medicare tax for anything over $250,000. So calculate how much Medicare tax for the year for the couple. The lower rate, $250,000, we're going to apply just the 1.45%. Doesn't change. We come up with this number. The higher rate, they are $22,043.20 above the 250, so that's taxed at a higher rate of the 2.35% to come up with this number. The total Medicare tax for the year is simply adding these two together. Now we have to determine the ratio that Presley should pay. Now, in reality, it could be that the person who makes more gets more taken out, but we're assuming that they're going to pay their relatively equal share based on their income. So Presley's ratio is Presley's income, which is $145,745.60, divided by the total household gross income, and that ratio comes out to be 53.57%. So we're going to determine the total annual Medicare tax that Presley should pay. So it's going to use this number, the total that they both pay, not just one, but together they will pay, and figure out how much of this Presley should pay. So you take that times this number, 53.57, and you come up with $2,219.60. Now that we know how much Presley should pay a year in Medicare tax, we have to figure out how much Presley should pay per pay period, which is biweekly. So since paid biweekly, divide by 26 pay periods. So this number divided by 26 comes out with $85.37 Presley will pay every 2 weeks.